Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market 5. I'm your co-host Joel Elconin, along with Dennis Dick, and we have Rob Friesen on the line. He's the president of Bright Trading. Rob, how you doing on this Thursday morning?
Great. Thanks for having me on the show.
Tell us a little bit about Bright Trading. Of course, Dennis and I are real familiar with it, trading for that firm for several years. Tell us about the firm.
Bright Trading is a proprietary trading firm which basically capitalizes traders in their career. Licensing is required. Our regulatory body is Chicago Stock Exchange, and we are regulated in the industry by the SEC and our regulatory bodies. So it's a little different than retail trading with a retail broker. This is where a trader gets to use good faith margin from the firm over and above their own starting capital. So we've really been in the business of capitalizing traders for their career for many, many years. Firm was formed in 1992. I joined the firm in 98, and so been with them a long time now. So.
I was a year behind you there, Rob. I joined at 99. I'm still with Bright Trading here as well. So I've been with Rob here a long time, have a lot of interaction with you. Rob, let's talk about the Fed first here. What did you think about the Fed yesterday? And what do you think about, obviously, as we start coming into the summer months, about the market overall?
Well, I think the market getting a little bit ahead of itself and trying to figure out, when they're going to raise rates and all that. I think it's a very, very tough landscape for any central bankers to conduct business. I mean, you've got essentially trade problems, currency wars. I think we can expect greater volatility in the currency arena. I just think it's a very tough landscape, and not surprised at all that things have to be pushed down to another time frame. So, I mean, a quarter point in September, is probably workable. The market seems to pout all the time when there's a hint of this is going to happen, and kind of runs a relief rally when it doesn't happen. So we've become addicted to low interest rates, and the consumers especially have squeezed more out of that. And if the rates start to rise, I think there might be a little bit of concern. I mean, really, we could probably handle 2.5 to 3% on the 10-year without too much problem. Although the market always factors in, looking down the road at this trend is going to continue. As soon as we start heading towards 3, it's going to be like, well, we're going up forever, and that's the attitude of the market generally. So. But I think a tough landscape. I don't, I wouldn't want to be in their shoes at all.
Rob, from your trader's perspective, though, you just want movement, obviously, anyways. Yeah, a lot of your traders, and I know I'm one of them, employ a lot of hedging strategies, and pairs trading is something that a lot of your traders do. Can you just explain pairs trading and how you use, different hedges to obviously extract different alpha from the market?
Well, really, the premise for a pairs trade is that the trader believes that his long dollars, the investment in the long side, will outperform his short hedge. That hedge could come from a peer. It could be like Coca-Cola versus Pepsi, Verizon versus AT&T, Lilly versus Merck, Caterpillar versus Deere, MasterCard, Visa, those type of relationships. But if you're going to put some money to work in that, you really have to look at what's your arguments, what's your probabilities for the long side to outperform the hedge, the short side. And you certainly don't want to open yourself up to big risk by hedging. It's supposed to be a way of reducing risk and taking some of the market direction out of the equation. I mean, here we've been in a trading range now for 3 months, really. I mean, we keep going up and down like a schizophrenic yo-yo here. So, we're not really, trending anywhere at the present time. So it's a good landscape. Some of our pair traders have had a really good environment here for trading the noise of the market. But it's nice to be able to put your hedges on and take away that directional exposure and just constantly harvest the noise that the market's giving you. So if that was to continue for years and years, it's an exceptional landscape. I think where pair traders get in trouble is when we do trend and they don't adjust their dollars, they don't adjust their betas, they don't look at what's happening in terms of performance, because a lot of these algos do chase performance. And there's that high frequency tractor beam, as you mentioned. There's a high frequency leapfrogging, and we have a bit of a struggle with a seriously trending market. And I know a lot of pair traders struggled from the quantitative easing that started in March 9th of 2009. um, and the market correlation increased, and so you're kind of trading a market of one, and it became a little tougher landscape than we had in the years previous. We had many years of great pair trading with volatility. Then we had some struggles in the 2009 through 2014. But recently here, the correlations of all instruments in the market has dropped, and the landscape for pairs trading has improved substantially. My address to our firm at the beginning of the year was, there's tremendous opportunity in pairs this year because of some of these changes. We've taken a pause from QE, and a lot of the relationships have been disconnected, and there's great opportunity for them to come back together. And we've seen that this year already in many of the peer groups. So a stock can be traded against its ETF that it's a member of. Like, for example, a utility stock could be traded against XLU. An oil stock, integrated oil, could be traded against XLE. So a person's not relegated just to do like a Coke Pepsi or a Merck Lilly. They can work within the ETF and stock structure that exists, looking at what weightings are there, what type of performance is happening with the stock versus the group. For example, Apple is a member of XLK. You were talking about Apple earlier on the show. It makes up a very large percentage of XLK, and it has been outperforming XLK. So there's an opportunity for somebody to trade that performance difference, to press the trends within pairs. Don't think of pairs just as a mean reverting instrument, something, well, I'm going to short the strong one and buy the weak one, and I'm going to say my Hail Marys and hopefully it works out. There's an opportunity to trade it in so many different aspects, to use the pair to take advantage of relative strength, or to use the pair to trade the noise if that's what the market's giving you, to look for mean reverting opportunities, but also to look for breakout opportunities.
Rob,
So,
do you you're still there, Rob? Okay.
yeah, go ahead.
Rob, do you pay attention to like the fundamentals, of the stocks or charts? I mean, where do they come in? There's fundamental and there's technical analysis. Where do they come in when you're pairs trading?
If somebody wants to carry a portfolio of pairs and they're taking those in what we would call a market neutral swing trade or a hedged swing trade overnight, I think fundamentals do play a bigger role. I think that technicals play a bigger role during the day, as you may not have much in terms of the changes of the fundamentals of the company. There might be sentiment changes, there might be news catalysts, or there might be macro influences, but you don't have as much fundamental change on a company day to day, unless, of course, there's an introduction of some news of some sort. But yeah, I think fundamentals are something you should look at if you're carrying them overnight. And here's a clear example. Would you want to be long Facebook and short Twitter, for example, if you believe that, Twitter might be a takeover candidate, or, putting some of the, I think people get into trouble in some of these areas of technology where they just put a pair together because they think it's a pair, but they don't understand the implications of shorting something that might be a takeover candidate or have a particular potential to really run because it's such a small company, very small float, that kind of thing.
And do you pay attention to the charts of the pairs? Do you have them up, or do you just keep the charts up of the individual stocks?
A person, if they don't have opportunity to use a charting service that has the ability to create a spread and then display that spread in real time, they can take two stocks and just trade based on the performance individually of each stock. And there's nothing wrong. Even a pair trader that's only watching spread charts should drill down to find out what's going on with the single stocks. Like, again, the objective generally is that your long dollars will outperform your short dollars. If both stocks go down, the way you make money is that your long did not go down as much as your short. If you have both stocks go up, your long went up more than your short. And if both stocks stay roughly in a trading range, you want to trade that noise or that back and forth chop by taking advantage of, the standard deviation of the movement there. So, there's opportunity to do a number of different things, but you're generally going to make money either in a compounded effort of, hey, I'm taking some scalps out of this pair over time, or I'm going to get some directional movement of the pair, and that directional outcome goes back to the fact that your long has to outperform your short.
Rob, a lot of your traders are starting to use algorithms, or actually, in some of our cases, like me, we've used algorithms for years. You've got some new programs there running pairs through algorithms. Talk about those a little bit. How traders are utilizing algorithms in the pair trading world.
Well, I mean, we do have through our order entry system. We now have Ready Plus. We also have Real Tick. We also have the ability to establish fixed connection to our clearing firm for traders. These are things that have come out in recent years. So we've improved the technology landscape so people can connect in various ways. They can run their own programs now, and we also have a cloud-based program that can trade pairs. We have the Omega Law pair trading engine, which is a great program for pairs. And it works the pair by canceling and replacing orders and trying to get the spread on for exactly the spread price that you're asking for. Monitors the pair, monitors different distributions of capital in the pair, and then it's all done automatically. For example, we have people that can trade a very liquid stock against a very illiquid stock, and the hard side is obviously the illiquid one. The program will work to put that illiquid stock on at a good price and then hedge with the liquid one. So that's been working out. It's cloud-based, which means they can run it through their iPad or their tablet or their phone. I mean, they don't have to be stuck at their desk in the same capacity as they used to be. We also have a new program that's a multi-strategy engine. This allows traders to create their own strategies, to use existing strategies that are on board. We have breakout and reversals. Some of the guys were having a great time yesterday with the relative strength reversal strategies during the Fed announcement and so on. So it's a single stock program, but the person could, again, look at placing bets on the individual stocks within a pair combination. So one idea is to have all of the long stocks that you would love to own in pairs, and another list is all of your short stocks, and let the program find the opportunity to put one of those sides on, and then you have the option to hedge it or not hedge it. We call that crutch trading, basically, where you're taking one side of the pair and you're only using the other side as a hedge if necessary. Otherwise, you wouldn't employ the hedge. If you don't need the hedge, why hedge? So this is a multi-strategy engine, allows for, you could put 4,000 symbols in there, multiple lists, multiple strategies. You can apply strategies to various lists. You can have more than one strategy per list. You can have more than one symbol per list. I mean, or the same symbol in different lists. So it's a whole different concept, kind of like a trade laboratory for our traders now. So that's a new evolution in our firm.
Are they instruments or for day trading? Do you need a little bit longer time horizon? Combination of both. Like what's the shortest time period you'll have something on, and is there pairs that you've just have had on for days or weeks or months that you just are constantly readjusting?
Well, that's a great question. I mean, if you're trading a highly correlated pair, I'll just throw one out. Say, everybody has probably a good chunk of people have Comcast cable. They have an A stock and a K stock. So they're two different classes of stock of the same company. The spread doesn't move very much, maybe 15 cents a day back and forth, a couple dollars over a year at most. So very, very tight spread. It requires a lot of capital to trade it. Now, if a person's going to benefit from something like that, they would have to probably establish a core position and trade around that core position by adding and subtracting different units of capital that they've established in the pair. Very relatively low risk in something like that, but at the same time, it's capital intensive and there is costs for carrying capital. Now, uh, that that is an area where you can get production and maybe a bit of return if you said put the spread on at a really outlier situation like we've had sometimes with that pair where it's stretched out a bit because of merger talks, this and that and the other thing. um, to put it on there and to have the patience for it to come in while at the same time trading the intraday fluctuations. So that's an example of a highly correlated, very efficient. We call them a contractual pair or an A and B type of a pair relationship. If you move into something like Conoco versus Chevron, it has great cycles of about $10 in movement, but you've got to tap into that. It becomes something that you probably don't build as big of a position and you try to, catch more of the swing trades in the pair. And again, the same concept, holding some and trading some.
We've been on the line with Rob Friesen. He's the president of Bright Trading, discussing the nuances of trading pairs and how to take advantage of them. Rob, thanks for coming on. We'll talk to you again soon.
Thanks for having me. Appreciate it.
Thanks, Rob.